we're going to be doing a session on options today. A little YOLO kind of strategy for earnings plays. I think you guys will find it quite interesting, and it's a way to use options to play earnings that's reasonably effective, because you'll find that most traders actually don't play earnings because it's such a binary event, and it's really difficult to make money at it. And I've found that for myself. So this is a way to sort of get in on the action, have a little bit of fun, and occasionally get a really nice payday. So let's just start digging into this. There we go. Yeah, so we're calling this Smarter YOLO. Okay, so quick disclaimer, everything we do here is for educational purposes only. We are not investment advisors and do not provide investment advice. All statements made here today are my own personal opinions and not to be considered advice to buy or sell any security. All trading and investment decisions are your own and done at your own risk. I think everybody knows who I am. So we'll just zip right past this and start getting into it. And along the way here, if you have any questions, go ahead and unmute yourself, and feel free to actually ask your question. Don't worry about interrupting me. I want to make sure you guys understand everything we're doing here. So you can unmute and ask your question, or you can type your question into the chat. I'll be keeping an eye on that. So let's get right into today's lesson. So here's what we're going to be going over today. So a Smarter YOLO for earnings season. We're going to start with a strategy overview. We're going to go over how we scan for candidates. How do we look for companies, for stocks that would be good for this strategy. And then we'll get into the option chain, and we'll look at how we select the spread, and then how we manage that trade once we're in it. And then we're going to review, and we'll have lots of time for Q&A. So one of the things that's cool about this play is it's basically, it's a YOLO play. It's fun. But there's less risk in this, because we have a really good chance of actually making a tiny little bit of money. So basically, we have a really good chance of turning this into a free trade. We're going for the YOLO. We're going for the great big payoff. We're not going to hit that very often, right? I mean, that's sort of what makes it a YOLO or a lottery ticket, right? We're rarely going to hit that big payoff, but occasionally we will. But along the way, we make little tiny bits of money most of the time. So it's like a free play. So we have a higher win rate than, so if your typical YOLO for earnings is you just go buy some out of the money calls, and you sit there, and usually what happens is earnings comes out. If earnings disappoints, the stock goes down, your calls are worthless pretty much instantly. If earnings come out and earnings are okay and the stock goes up a little bit, even though you were in the right direction, there's usually volatility crush. So the options aren't worth as much anymore as what you actually paid for them, even if you pick the right direction. So there's lots of ways, just with buying calls for earnings. There's lots of ways to lose money doing that. Your win rate on just straight up buying calls is probably 10, 20, 30%, something like that. This strategy has a much higher win rate, in the area of about 60%. Although most of those wins are really small. So like I said, there are lots of small winners. We also have lots of small losers, but our losers are also very small. And we have occasional home runs. Most of the time you get paid for the opportunity to trade for outsized gains. Like I mentioned, this strategy will pay you a little bit to sort of take this ride. Hey, Sarma, welcome. You haven't missed much. We're basically on the first slide here, so nothing really for you to catch up on.
Thank you very much.
Yeah, no problem. So one word of warning here: this is not for everybody, right? And this is not a better bread and butter trade. You're probably not going to be able to earn a living with this trade, but it is a way to make a little bit of money, during earnings season, and to have some fun. I think that's the most important thing. Look at this as a way of having fun, and maybe as a way of preventing you from taking some of the bad options trades that people take during earnings season. Trades like a straddle or a strangle. I mean, those are always losers. Just buying straight up calls. So this is a way to kind of get that out of your system, and hopefully make a little bit of money along the way as well. So like I said, just have fun with this.
Thank you very much. Just I didn't do options till today. Just I want to learn about options. Just.
Sorry, can you repeat that, please?
I didn't do any options till today.
Okay.
I just want to learn, and then maybe. Thank you for everything.
Oh, you're welcome. You're welcome. Yeah, just watch along with us. If you're really new to options, I suggest going back and watching lesson 1. So this would be I think this is the 5th options session I've done. So I suggest going back to the beginning, because a lot of this is a little bit more advanced what we're doing here today. So a lot of what we're going to talk about is going to go over your head, and we won't have time to review everything to sort of get you up to speed. But if you go back and watch some of the earlier sessions, and if you want, you can DM me, and I'll direct you to the first session that you can go through, and you can go through my own series. And there's also some other resources I can direct you to as well. So yeah, just enjoy this session, and we'll keep on moving along.
Sure, that sounds good. Thank you.
Oh, you're welcome. All right. So options, a Smarter YOLO. So this is best as an earning play on stocks with high short interest. Okay, this is important. This is high short interest. So the reason for the high short interest is that's another potential catalyst. So we have earnings. Let's say they have a beat on earnings, and we have high short interest. Put the two of those together, and the stock could really take off. That's how we hit a home run. So those are the kind of stocks we want to play for, at least during the earnings season. But this can also be used for any event when you think that there's going to be a very large sudden move in the stock price. For instance, maybe you know that a stock has or a company has an FDA approval coming soon. This might be a good play for that, especially if that company also has high short interest. What else would be an event? There are lots of sort of company events that are coming that are a very specific date, and you could do an options play like this right before that event. We'll only be looking at the bullish side of this trade, so that'll be the call side of this trade. But it can, and if we have time, maybe we'll look at a put, a way of doing this, or bearish with puts, if there's time later. But you can flip it and trade it bearish by using puts instead of calls. And I think that'll be pretty obvious how to do that once we get into this. So there is unlimited upside in this trade. The upside is only, it's determined by the stock price, obviously, and the amount of time that you can stay in it. But if you had used this trade on something like GameStop or AMC back when they had their short squeezes, this would have worked fantastically for that. The other great thing about this trade is it has really good defined risk. we know before we even go in the trade, what is the maximum amount of money we can lose. And I always like options trades like that. I don't like open-ended options trades. I want to know what my risk is before I go in. We can profit even when we're wrong. Okay, so let's say, the company has earnings. Obviously, we're wanting, the stock price to go high and get a short squeeze going, and it just takes off. That's our win, right? That's our home run. But what happens if earnings comes out and the stock price goes down? Well, if that happens, we can actually make a little bit of money. Not much, just a few dollars, but maybe enough for dinner. But yeah, we can make money when we're wrong with this trade. And that's always nice too. That's how we get paid. That's how we get paid to play this trade. Okay, so what we're looking at here is the return graph, okay, the profit and loss graph on an option strategy. And this option strategy is called, I'm calling it a Smarter YOLO, but the option strategy is actually called a ratio back spread. I think somebody's got a noisy mic or something. Huh, weird. So, okay, now this solid line here is our return graph, okay? So you can see anytime this solid line is above the 0 line, that's our profit, okay? So you can see when it's, over in this area, okay? Oh, and the horizontal axis here is the stock price, okay? So we can see down here when the stock price goes down, we make a little bit of money. And we can see up here, when the stock price goes up, we make a lot of money. And this is where we get into, this just keeps going up forever to infinity. And this is where that unlimited upside is. And this area right here, this little triangle under the 0 line, I call this the valley of death, okay? We don't want to get into here. Okay, so this is our lower break-even point. So everything from here down, we make money. And this is our upper break-even point. Everything from here up, we make money, okay, in the stock price, all right? This point right here is the price of the call that we're going to sell. This is the strike price of the call we're going to sell. And this right here, right at the very tip of the valley of death, is the strike price of the long calls that we buy. And you'll see how this works in more detail in a little bit. But hopefully this makes sense to everybody. If it doesn't make sense, let me know. Or maybe we'll get into a couple examples first. But it's important to know that kind of this is what it should look like when you bring this up in your broker platform and look at your return curve there. This is what you should see. Okay. So what we want to do is we want to sell very near, very close to at the money calls, okay, or a call. This is a ratio spread. So, for instance, you would sell 1 call and then maybe buy 2 or 3 or something like that. We'll go into that in a little bit more detail in a sec. You're going to use the proceeds of selling that call to buy out of the money calls, okay? So you're selling a call here, and say this is $15, okay? This is the $15 strike. You're going to sell this $15 strike, and you're going to use the money you get from selling this to buy calls up here at, say, 25. And what you're going to do is you're going to buy as many calls as you can with the money that you make from here. Now, if you sold this for $10 and these calls here cost you $4.50 each, well, then you could buy 2 of them, and that'd be a 1-to-2 ratio spread. Maybe you're able to sell 2 calls down here and buy 3 calls up here. The important thing is a ratio between how many you sell and how many you buy. Now, it's normally the ratio is 1-to-2, but it could be 1-to-3, could be 2-to-3, or whatever. 1-to-4 maybe. just experiment with it, play around, look at the numbers, and see which one works best for you and your risk profile. Now, the really important thing here is it's important to remember you must earn a credit. Okay, so like I said, say you received $10 here for selling selling one call, and you bought 2 calls here that were $4.50 each. Well, then that's $9 total, right? You've still got a $1 credit. That's important. Now, if these calls here were $5.50 each, to buy 2 of them, that would be $11, and then you would have a debit. You'd have a $1 debit. That doesn't work with this system. We have to make sure we receive a credit. We'll look at some examples shortly, some live examples on my broker platform, so you can see how this works, from your option chain and how you would actually place the order. Okay, so our next step is we want to scan for some stocks with with earnings coming up and with high short interest. And we're going to do that in FinViz. You can do that with a free account. It's better if you sign up at least for an account. You can sign up for a free account there, and then I think you get to save some of these settings. But we're only changing 3 of these settings here. So even if you can't save them, it's not that bad. And you can see here's an example of one a scan that I did yesterday, and we'll look at this in more detail in a sec. We'll pull this up live and do another scan, see what's coming up for next week. But the settings that we want to change here, and you can see when you go to Screener right here at the top, if you click on Screener, it'll bring this up, and you can just change some of these settings. Just click all right here, so it brings everything up. So the first thing you're going to want to set is the earnings date. Now that is right here. And you can set that to, there's a number of different options there. You can set it to tomorrow if you're looking to see, okay, what's got earnings tomorrow? What's got earnings tomorrow morning or tomorrow afternoon? And then you could do that scan every day. You could see what's going on for the next 5 days or the next week, etc. You can do a custom, well, if you have a paid account, you can do a custom date range in here. The point is, just pick a time when you do your scan. I mean, the weekend seems good, and you want to look for, see what's coming up for the next week. Really important, we want to have a short interest or a float short of over 10%. And you can see that. You can see that right here. I've got this in this column here, and all of them have, short interest over 10%. And that is right there. We've got some other options. Now you could go, you could have stricter criteria. You could say, I want the short interest to be over 15% or 20%. But 20% is getting really high. You're not going to get too many candidates. And you can see if you did this for next week, you wouldn't have any at all, at 15% or 20%. I think 10% is pretty good. It gives you some stocks to choose from. So the next step in this that we want to set over here, it says option/short. We want it to be optionable, of course. We want to be able to trade options on this. And of course, we want it to be shortable. Okay. So that's it. That's all the settings you need. By virtue of the fact that it's optionable, it's going to weed out some of the penny stocks because there's no options on anything under $2. There'll still be some of the, $3 or $4 stocks. So you kind of got to use your judgment if you want to play on those or not. I usually don't, but you never know. I mean, there can be some good plays there. The important thing, though, is that it's got high short interest. What's next here? But yeah, and I set some custom columns, and I'll show you how to do that in a second. And I want those columns to be float short and earnings date are the ones that I want to add into that customs columns tab. All right, so let's go over to hang on a sec here. Let's go over to FinViz, and I will just bring that in here. Okay. Oops. Sorry, just bear with me one sec here. All right. So you should see FinViz on your screen right now. And I've already got a preset screener. I'm just going to bring that up. Okay. Now I've got mine set for the next 5 days. It's not showing us anything. So I'm just going to change this right here. I'm going to change that to next week. So that should show us all the stocks that have earnings next week and that have high short interest. Now you can see we can't see in the column. We don't see what the short interest is in any of these columns. We don't see what when earnings date is. Now, if we clicked on one of these, we would be able to see that stuff. Okay, so we can just click on American Airlines here. We get to look at a chart, and we get a whole bunch of data. And it's, you know, there's a lot of data on here. Here's earnings right here, okay? So this has earnings on July 21st before the market opens. Okay, and over here we have shares, whoops, short float, 12.9%. Great. That's great. You know, that's the information we're looking for, right? But what you can do, let's go back here. And I'm pretty sure you can do this with a free account. You can go to the custom here, and you can see that I've already set this. And so if you go to settings right here, it'll show you all the columns that you can put in here. Okay. So I've already set this up. I've got the short float and I've got the earnings date. So let's see if we can find a good one here. I think, you know, this AutoNation might be good. And another cool thing is when you mouse over the ticker, you can see it brings up a chart. So, I mean, what would be really cool is if I could find one that has been going up recently, like American Airlines has been going up, right? You know, so if it's going up into earnings, that's awesome because it's, you know, it's already possibly starting to squeeze those shorts a little bit. This one looks like it's been pretty flat. Here's one, this COM. It has been going up nicely in their earnings. Why don't we take a look at this? So I'm going to bring up a chart on this, and so we'll look at COM. Before we do that, we look at the float short, 12.5%. That's pretty good, and it has earnings on July 19th. Okay, we'll just quickly bring up a chart here, and FinViz has some half decent charts, and yeah, we can see this has been in a nice uptrend recently. So it's quite possible that the market is expecting decent earnings out of this. Now, I might, you know, before I do this trade, I might do a little bit of fundamental research. I might take a look and see what the analysts think about this company and what they're expecting for earnings. We won't go into all that now. I'm going to assume you already know how to do that. You've already been researching your own stocks for your, you know, your investment portfolio and for other trading purposes. So just, you know, do a quick little bit of your process just to make sure that this does have a chance of going into the short squeeze, that it has a chance of having really good earnings, better than expected earnings, and it could go up. Okay, and yeah, so this doesn't look too bad. You know, this has been moving up nicely over the last little bit. The only thing that bothers me is kind of it's consumer defensive. So it's probably, you know, these tend to not move very much. You know, they tend to not be very volatile. Where's my volatility here? Actually, here, let me bring this. I'm going to bring this up on my e-signal, and I can bring up the. I can see just how volatile this is right away. What do we got here? Oh, okay. This, you know, on an average day, this moves plus or minus 3%. That's not too bad. So yeah, we could get something out of this. All right. So now we have a candidate. What we need to do next is we need to figure out, you know, what do the market makers think that this is going to do? And a really easy way to do that is we can go to one of my favorite little sites, and this is another free site. and it'll quickly give us the piece of information I'm looking for. And I've showed you guys this site before, optionslam.com. Okay, now I just brought up com here, and if we look up at the top here, okay, it tells us when the earnings is, tells us how many days to earnings, 5 days, and it tells us, now here's the important part, okay? It tells us what's the implied move on the monthly contract. Now this one only has monthly contract. So it's telling us that the implied move on that monthly contract is 10.79%. Okay, that's the contract that expires in August. So between now and August, they expect that to move 10.79%. Now, because earnings is coming up soon, that's really what the implied move on our earnings is. So we want to keep that on the back of our head. Because we probably want to have our long calls around that level or just outside it, okay? Because we're expecting, what we want to see happen is we want to see a bigger than expected move on earnings. So we want to see this go more than 11%, okay? So now that we've got that information in our head, let's go over to our options chain and see if we can find any good plays in this. Okay, so we're going to be looking at those. Oh, you know what? Actually, before we do that, we'll get back to that screen in a sec. All right. Yeah, we're gonna select our spread now, so we need to look at the options chain for that. Okay, and I'm sure everybody knows how to read the options chain by now. So we're looking for the we want to buy these options, or we want to buy this spread right before earnings. Okay, we want to wait till the last minute to get into this spread. So if earnings are tomorrow morning, then we want to enter this spread in the afternoon today. Okay, if earnings are after the close today, then we want to buy this spread or enter this spread in the afternoon. We want to do this right before earnings comes out. We just need to give ourselves enough time that we're not rushing into the trade right before the close. Okay, so this needs time to work. It also needs liquidity. Okay, we need to be able to get in and out of this fairly easily. So we want to find some liquid contracts with 3 to 6 weeks to expiration. Okay, if earnings are tomorrow and this expires the day after tomorrow, kind of thing. That's not good. That doesn't give us any time. If it starts to short squeeze, a short squeeze takes a couple of days to get going and get a little bit of momentum. And the short squeeze can go on for weeks. So we need to give it time to set that up. And we also need to give it time that our options don't expire before the short squeeze is done. We want to be there for the whole ride. So let's give it 3 to 6 weeks. We also don't want to be buying too much time. We don't want to be buying 3 months worth of time, because then that gets expensive and then it increases our max loss. Okay, so 3 to 6 weeks is pretty much the sweet spot. Monthly contracts are usually best because they have better liquidity. But if something like if something like Apple, had a high short interest and had earnings coming in, wanted to use this play on it, you could use weeklies on that because Apple has tons of liquidity. The short call should be at the money or slightly in the money. Okay, so we'll take a look at those in our example in a sec. We want to, play with a ratio. I usually start out when I'm looking at these. I start 1 short and 2 longs. That gives me a frame of reference. See how that looks. I'll also look at 2 shorts and 3 longs, and I may even go to 3 shorts and 5 longs or something like that. The bigger these numbers get, of course, the greater your potential max loss is. So be careful there. You know, that the most important thing is to sort of watch out for that max loss. Even though it's very unlikely that you're going to take a max loss, it's possible, it could happen, and you don't want to be risking more than you can afford to lose, obviously. And you know, this is just meant to be a small play. So don't be taking a bunch of risk on it. Okay, and all important, you must receive a credit. And the max loss, like I said, must match your risk tolerance. Okay, I think this is where we're going to, this is where we're going to take a look at a live example of this. So we're looking at the option chain for COM now, okay? So we're only going to look at the call side here. And we can see that right up here, COM closed at 53.17. So our at the money calls are, you know, somewhere between, you know, at the money is basically between 52.50 and 55. Okay, I'm going to go with 52.50, and we're going to sell one of these 52.50 strikes. We're going to receive $2.95 for that, and we're going to need to buy. A couple, at least 2, possibly 3 calls. Now, let's see, if we buy 2 of these calls, if they actually cost us $1.55, that wouldn't give us a credit, right? Because we're only receiving a credit of $2.95, and then the $1.95 or $1.55, that would be a debit of $3.10. So our total would be a debit. We would be paying 15 cents for this. We don't want to do that. Now, the reality is we'd be paying somewhere in the middle, and we would be fine. You know, it'd be fine to buy 2 of these if we were paying somewhere in the middle. But for this example, I'm going to just pretend that this one won't work. I can't buy 2 of these for what I sell one of these for. So I'm going to move up to here, the 95-cent one. I can definitely buy 2 of these for the credit I received, the $2.95, right? Because this is only going to cost me $1.90 for both of these. So I will receive a credit. Now I need to change quantity here to 2. Okay, and you can see I should receive a credit somewhere in the middle of this. So I should receive a credit, you know, probably around $1.60 or so. So that would be quite nice. Now let's look at the profile on this and see what this looks like. Where'd my profile go? Oh yeah, it's going to be hiding in here. Sorry, bear with me one sec. I'm going to have to do this a little differently. Okay. Sorry, this is always a pain using this thing in the broadcast. All right, there we go. Let's put that right there. All right, so here's our risk return profile. Okay, let's change that a little bit here. Remember that picture we looked at earlier? So everything from here down, so basically from, what is that, 52.50, right, which is where our short strike is, all the way down to 0, we make money. How much do we make? We're going to make about $100. It's telling us. It's actually be a little bit more than that, but it's telling us we're going to make $100, right? Our minimum investment minus $100. That's the credit that it thinks we're going to receive. And then from here on up from about $66. We make profit, and you can see the profit starts to go up considerably as the stock price rises. Okay, now that's that solid line. That is the value of this option contract, this spread at expiration. Now the dotted line is the value of this spread right now. Okay, across this range of prices. I see Sabia has just asked, aren't you going to change the date on the long call? No, I'm not, because if I did that, that would be a calendar spread. That is another way to play it, and that is there is a nice little option strategy where you would use a calendar spread. But if I did one call at one on one contract month, and then I did another call on another contract month, that would be a calendar spread. And this is a ratio back spread. And we could actually do a ratio back spread with the calendar spread as well, but that's not what we're doing here today. Okay, so that this would be one option for us, or one way we could do this. And if we look here, our profit probability is 56% on this. Now, most of that profit probability comes from down in this area here, right? Which wouldn't be very much profit. It would be the amount of credit we receive if this expires worthless. But we've got a little extra money to play with. What would happen to this if we say bought, if we bought 3 of these? Oh, I also want to point out here our max loss. The potential max loss on this is $645. Okay, this is going to go up when we buy more of these. Okay. Right. Where did my? Oh shoot. Lost my profile again. Good. All right. Is this the right one? Yeah, this is the right one. Okay. So here you can see we have a lot less profit to start out with. We can see that our max loss has gone up a little bit because we're buying another call. Okay, but you can see how the return on a short squeeze gets much steeper. Okay, so this is sort of, you need to play around with this and find what works best for you, what suits your personality best when you're doing these, because there's a lot of different ways that to make this work. Let's do another example here. Let's go back to a 1x2 and see if we can make a 1x2 work anywhere in here. Because what we could do is we could go down to, say, the $50 call. Okay, and we're going to receive $450 for that. And then maybe we want to do the $55 call. Now I'm just experimenting here. So you can see that if we sell 2 of the 55 for $2.20 each, that's $4.40, we get a 10-cent credit. Okay, so let's take a look and see what that looks like. Go. Okay, so what that gets us is we still get, you can see that, we get a tiny little bit of profit down in here. Our max loss has changed to $490. We still have nice steep return profile on the right hand side, but you can see our probability our chances of profit have gone down to about 51%. I kind of like this one. This is not too bad. This is something I would definitely think about. So, just experiment, right? Just, move these strikes around and see what you come up with. Okay. See how that affects your return profile. kind of disappeared again. Okay, I think you get it here. Does anybody have any questions on this part of it so far? If there's no questions, I will continue on. All right. Oh yeah, one last thing. It's best to enter these spreads, enter and exit these spreads as a single trade, if at all possible. And work the order. Never ever put in a market order. Okay. Actually, this is so important. I want to go back to this here. All right. You can see down here at the bottom. What is going on here? There we go. You can see down here at the bottom that the spread on this right now is, $1.90 credit to a 10-cent credit. Oh, sorry, this one up here, $1.10 credit to a 15-cent debit. If you just put a market order in on this, you're going to end up with a 15-cent debit, and you don't want that, right? You want to make sure you get a credit. So you need to work this order. You need to figure out what the fair price of this actually is. Just do a little bit of mental math here by checking your midpoints, and then put a price in, put a limit price in that's near that, and work that order a little bit. Never ever use a market order. Never hit the bid. Never hit the ask in the options market. The market makers, you'll make their day if you do that. They don't expect you to do it, but they put these ridiculous bids out there just in case you do. Okay, so don't let them take your money. This is what we do here is hard enough without letting the market makers take your money. All right, let's go back over here. All right, so now let's look at managing the trade. So when we're in this trade, we do not want to overstay our welcome, right? If this trade is not working, we want to get out. Because what happens is tomorrow morning, let's say we entered that trade tonight, this afternoon. Tomorrow morning, this has earnings. The market opens up. The stock is going down a little bit. That's okay. Chances are it's going to be in the money for us, and we can buy back. Now, remember, because we're receiving a credit, we're actually short this spread, okay? So to close it, we need to buy it back. And we should be able to, if the stock price is going down, we should be able to buy that back for a very small amount of money and just lock in a really small gain, make enough to go buy a coffee or a dinner or something like that. And so I would suggest you just kind of get out at that point, because you don't want to take the risk of holding this for the next 3 weeks, hoping that it goes to zero, right? As soon as you're able to sort of buy it back and still have a little bit of profit, just get out of the trade, because it's really not working out for you, right? It's not giving you the home run. Okay, you'll know when you've got a short squeeze on, you'll know if it's going to be the home run, because it'll start going up, and it'll start going up fast, and it should do it right away. So if you're wrong, if this doesn't work, just get out. You don't want to get caught in the valley of death here. Okay. See, this is, if this expires right down in here, that's your max loss. You don't want to be there, right? Not so bad if it expires right here, at this price and in around 120 or 130 or something, that's not so bad. But down in here, that is going to be your maximum loss. You don't want to be stuck there, right? So we need to get out and not give it a chance to get us down in that area. So if the trade is moving your way, though, and it's starting to squeeze, well, then obviously we want to try and stay in it as long as possible, right? We want to ride that all the way to the end if we can. But, these short squeezes can end really quickly and suddenly. So best practice, if you have multiple of these, and I usually do suggest, if it fits your risk management, that you buy at least 2 so that you can sell one for a profit somewhere along the line. So if this is working really well and you see in the stock that momentum starts to slow, you would want to get out at the first sign of slowing momentum. So what does that slowing momentum look like? Let's take a look here. So here is, I'll just bring in the chart of COM. Now, let's say that, earnings were on this day right here, right? And so this started jumping up, it's going up, everything's looking great. Goes up, and then this day comes. It goes up a little more, and then it goes green to red. It starts coming down. It's coming down, it's coming down. Well, you know what? When you're looking at this, you should probably be thinking to yourself, ooh, this is not good. We've had a really nice run. I've got a bunch of profit sitting in this thing. This is the time I want to sell some. Now, you don't want to sell it when it's way down here. When this is maybe down a third the length of this candle, right? Or maybe halfway into the day before, that's when you kind of got to go, you know what? It's time to take some money off the table. But maybe you think this can run farther. You think those shorts can get squeezed even harder. So you're only going to sell maybe half your position. And, it goes down a little more, but then it pretty much goes sideways. And then we get another move up. And you can see when we get this next move up, we get two really good days. And then we get this little kind of, this little hammer day here. And then we get a bunch of dojis here. Well, it's run out of steam. I would close out the rest of my trade up in here, probably on this day, this first day, that after these two big days here, probably closing out on this day, and I'd close the rest of that trade out, and that'd be it. It'd be done. We had a nice winner, right? But if these days continue like this, if we continue this momentum to the upside, I want to try and stay in it. That makes sense? Okay. What do we got next here? And we want to exit all of the position, before expiration. We don't want to have to bother with, don't let it expire, because that can get messy and dangerous things can happen. Even though, part of the trade might look like it's worthless, it's not necessarily worthless. And you don't want to, if you want to own the stock, just buy the stock, right? Close out your options, close out your option trade, and then just buy the stock. And the other thing you don't want to do is, because I want to be clear on this as well, so I'll just bring this back up again. Now remember, we're short a call here. That short call is covered with these long calls, okay? Without these long calls, this is just a naked short. So when you go to close out the trade, don't close these long calls separately, thinking, oh, I'll just close these long calls now, and then I'll close the short call in a little bit. Don't do that, because you're naked these short calls, and you never, ever, it's the worst thing you can do as an option trader. You never want to be short naked calls, because you have no protection. You have unlimited downside. What happens if COM suddenly halts and announces that they have just found the cure for every cancer ever known? And they're going to sell everybody that cure for $20,000. Well, everybody on the planet is probably going to try and save up $20,000 and buy their cancer vaccine that works 100% of the time. This company is going to be worth trillions. And if you were short, these calls, when this stock reopens, you're broke. You will never be able to pay back, what this goes, because this stock is basically going to infinity, and you owe infinity to somebody. Now, they're not going to find a cure for every cancer ever known or a vaccine for every cancer ever known, but you kind of get the point, right? Stocks can go up an awful lot very suddenly, and it can wipe you out as a trader if you're short a call when that happens. So keep your spread together. Keep the protection you have of that long call when you are short, and sell these two pieces together. Or if you do have to sell them separately, buy back this short call and then sell your long calls after you've bought this back. Don't even be naked in this for like half a second. It's just not worth the risk. Okay. Let's go back over here. Hopefully I was really clear on that. It could just be such a dangerous thing to do. All right. So let's review really quick here. So this Smarter YOLO is great for earnings. but it works for other binary type events too, like, you know, an FDA approval that you know is coming or something like that. We want to enter liquid contracts. You know, we need to have some volume in the contracts, you know, so we have somebody to trade with. We want to enter liquid contracts as close to the event as possible with a minimum of 3 weeks to expiration. For our call plays, we want to see a high short interest of 10 to 15%. Even higher is better. We want to sell an at the money or somewhere near at the money call, and we use the proceeds of that call, proceeds of selling that call, to buy multiple out of the money calls. We must receive a credit when we do this, and we also must do this as one single transaction, right? We must receive a credit. If it doesn't move right away on the event, on the earnings release, get out fast. Get out as quickly as you can. As soon as that's showing you some profit, I would suggest you get out. You don't want to be hanging on to this, you know, taking a bunch of risk. It's just not worth it. And, you know, like we said shortly ago, don't get trapped in the valley of death. Stay with the trade when the squeeze is on, but try to lock in some profit when momentum slows and have fun with it. Okay. I said I would show you one. I'd show you how this also works with puts. And does anybody want me to do that? See how we could use this on the short side. If there was an event, if we were really convinced that this was going down rather than up. And I can actually show you a stock that I'm thinking of playing that way. So while we do that, the name of the stock or the ticker of the stock is RHI. Yeah, yes, Abid. It could definitely be useful in this current market context. Okay, let's take a look at this one. So this company does. I got this idea from my buddy Ari. He used to be in the Discord quite a bit, and he comes up with some really good ideas. So I appreciate him sending this one my way. These guys do human resources. They're headhunters basically, and you know, the thinking is with us going into a recession, well, all these tech companies, you know, saying they're cutting back on hiring or they're laying off. These guys should probably be taking a little hit in revenues. Now they have earnings coming up shortly. Their earnings are on July 26th. They have their short interest isn't high though. This is the only problem, right? We've got short interest of 5.9 million on a float of 107 million. So, well, this isn't that kind of play anyway. We're actually not concerned with their short interest because we're going to do a put play on this. We want it to go down. We don't want high short interest here. So yeah, so this is good. This is coming up soon. I'm not going to be playing this just yet. I'm going to do this probably the day before earnings, but I am going to be watching this stock. If this starts to like crash down through here, sort of like you can see I've marked out what it might do. If we lose support here, I might just jump in on this trade because I don't want to get it away from me. But you can see how right now we're at a fairly important support level. It did bounce up off of here a little bit today. This is actually a fairly bullish candle in this. So this is kind of good. You know, I'd like this to just go sideways a little more before earnings. All right. But, you know, this is sort of the kind of action that I'm expecting on a earnings release because I think they're going to guide down. They're going to say, look, we've got some headwinds, you know, we're not selling as many of our services. People aren't looking for employees as much. People are laying off. You know, they're going to guide their forward revenues. They're going to be guiding down, which makes it a good play to be, you know, putting puts on. But because this is earnings, I don't want to be, you know, I don't want to just be buying puts. I want to have a chance to, you know, make some of my money back if I'm wrong. All right, so let's take a look at this one. There we go. So this is RHI. And the same month will work for us. This is the the August 19th expiration. And I'm just going to look. I had some notes over here on this one. So this is, yeah. So if we sell the 75, we sell the $75 put, which is just barely, or oops, oh, hang on, that's the call. There we go. Okay, so if we sell this $75 put, this is maybe going to be a little different. We might have to go to the 80 here. And I was looking at buying $65 puts. Okay, so that'll be, you can see I can do a 3-to-1 ratio on this. Let's see what this looks like. I may change this though, but we'll start out with this one. Let's take a look at our profile on this. Here's my profile. Is that it hiding back there? Nope, that's calm. Here we go. Actually, let's just do it this way. All right. So you can see here, we have our max loss, $965 on that. Our max return would be $12,000. Now, to get $12,000, this stock has to go to zero, right? And what kind of credit were we getting out of this thing? We're probably getting about a 50-cent credit or so. Or, yeah, we should get about a 50-cent credit out of this. And so that's what our return profile looks like. Not bad, right? Let's try a slightly different one. Let's move this up to $80. So our short strike would be in the money there, and then our longs are out of the money. Yeah, that'll work. We could still even do this at 3-to-1 and still get a credit on this. I wonder if there's a way to. It looks like that's the way to go on that. So what is our max loss on this going to be? Let's bring this just over here. Profile on this. Okay, yeah, you can see our max loss is about $980. Profile looks very similar, right? We get a little bit of credit, and we do really well if this plunges. So yeah, I kind of like this trade. It's a little bit pricey for my liking. It's $1,000 YOLO, but again, you can see here that it's a really narrow range where you're taking that loss, right? There's, the loss really shrinks as we move away from that $70 price point. So yeah, that's something we're going to be watching for coming up. That will get cheaper as we get closer to earnings because it's still got lots of time in it. So that's the way you can do this with puts as well. Right. So does anybody have any questions? And feel free to unmute yourself or type your questions into the chat. Nobody's got any questions? Good. I must have done a great job explaining this then. So what I want to do over the next couple of weeks, because we're just getting into earnings seasons now. So what I'm going to do is I'm going to find some of these trades. We'll probably be keeping a close eye on COM. That's one of the trades that I definitely want to follow for next week. Another one that I'm going to be looking at is AutoNation that's coming up next week. And I want to look and see if we can find plays in this. And when I do find some plays, I'm going to drop them into the options channel so that we can discuss them there. So I'll show you what these plays look like, show you how I might be playing it. And if anybody has any questions, you guys can ask questions in that channel. And if you guys, scan for these things, if you find any you like, maybe you're not sure about it or whatever, or maybe you want to show the rest of us. If you have any questions about it, just drop them in that channel. Drop them in the options channel, and I'll definitely respond to you in there if you have any questions. And if there's a play you like, share it with us. Let us know, because we might like it as well. Let's all work together and find some of these plays, and see if we can have a little bit of fun and make some money as well. So I don't see any questions coming in. So if later on, or if you're watching the recording, you have any questions, feel free to, like I said, ask your questions in the options channel, or you can DM me if you want to ask a question privately. That's all good. So what do we got coming up? I'm not sure, where you guys want to go. If you want to do more options lessons or look at more strategies like this, what is it you guys want to learn? So let me know. Shoot me a DM. Give me some suggestions for things that you'd like to look at. And coming up next Thursday, we have Ticker Talk, and that's on Thursday, July 21st. Also, over the weekend, probably on Sunday, I will be doing the regular weekend video. So watch out for that. And I hope to see all you guys on Thursday back here live for the Ticket Talk. Hope you enjoyed this. If you're watching the recording, hit that thumbs up. And, comment if you have any suggestions or questions. Go ahead and comment. And hopefully everybody enjoys the rest of your afternoon. Thanks for coming out, everybody.